Welcome to Fred's Financial Planning Workshops. Today we're going to be talking about risk management, otherwise known as insurance. I'm Fred Smith with the Silicon Valley chapter of the AAII, and I've given you my email address down here in case you have any questions or comments you'd like to make. And also these slides are available if you wish at our local chapter website, www.siliconvalleyAAI.org, financial planning. Before we get into the details, we've got this standard disclaimer here, which in essence says that these are for educational purposes only, and the views expressed are mine, not necessarily those of the AAII or the Silicon Valley chapter. Today's workshop is one of a series we've already covered in previous workshops, investing and taxes and retirement planning, and today we're doing risk management. And still to come, we have next up is the Social Security and Medicare, followed by estate planning. Okay, so today we're going to look first at the insurance model, how it works. We're going to look at some common insurance policies really quickly. I'm not going to go into much detail on those, but I mostly want to focus on the potential train wrecks, which include life insurance, disability insurance, long-term care, annuities, and umbrella policies. For the insurance model, what we're really looking to do, the contract, the insurance contract will transfer a risk that you are unable or unwilling to bear yourself to a third party, in other words, to the insurance company for a fee, for a premium. And you want to think of this as buying a service from the insurance company. For example, if you take your homeowner's insurance policy, assume that you have a home that's worth $1 million excluding the land, and that there's a 1 in 2,000 chance that it could burn to the ground in any given year. The premium has three components to it. There's the actuarial cost, which in this case will be 1/2000th of the $1 million value of the home. In other words, $500 per annum. And the overhead cost for the insurance company itself, they have to pay salaries and keep the heat and light on and everything. So assume that that's 30%, and they're entitled to a fair profit. So we'll assume that they get a 10% profit on the deal. These are only numbers put in there for convenience, but they're probably not that far off. So the total premium in this case could come out to be $700, and that's a 40% markup on the cost. In other words, insurance can get to be quite expensive. It's not a slight against your insurance agents or anything, but you've got the three components built in that push up the price. So the bottom line here, I think the takeaway message is that you only want to buy insurance when you really need it, and you don't want to use it for small items that you can handle yourself. Look to just covering those risks that could be life-changing if you get hit with them. Insurance works best for low probability risks with a high financial cost, and the homeowners insurance certainly falls into that category. If your home did burn to the ground, it's probably not something that you'd want to self-insure on. It could blow a big hole in your investment portfolio if you were not insured. On the other hand, insurance does not work well for low-cost events with a high probability of occurrence. The example I've given here is vision care. Anybody who wears glasses knows that they're going to have their eyes tested every year or two and get a new pair of glasses every so often. So that will not come as a surprise. So in general, insurance would not work well for that kind of thing, unless, of course, the insurance company was able to get a good cut from the opticians, and in terms of a bulk discount. That might change things a little bit. So you want to insure against the worst case outcomes. Don't bother calculating out what happens under average conditions, because you know that under average conditions, self-insuring is going to be cheaper than going through an insurance company, because you know that the insurance company has to add their costs to it and their profit. So, what you're looking for is coverage beyond the average, not the worst case conditions. The insurance company has a big advantage in that the theory of large numbers works on their side. And you can't use those averages. If you take the example of trying to figure how long you're going to live in terms of putting together a retirement portfolio, you don't know whether you're going to live for another 5, 10, 15 years, 30 years more. You just don't know. You can take guesses depending on your health and so on, but they're only guesses. So in general, what you want to do for your retirement portfolio is plan on the worst case, in this case, which might be living to 100 or more, 105 or something. You need to make sure that you live longer than your portfolio does, that you don't outlast your portfolio. So you have to look at what I call the worst case condition here. Most people don't think of living to 100 as being a worst case, but from the financial perspective, it could be. On the other hand, the insurance company has actuaries who know to the day, what the average person is going to live to. And they can price all of their products on the average parameters rather than the worst case. So they have a big advantage in that regard. They have all the data and we don't. I'll look real quickly at a couple of common forms of insurance first. For auto insurance, the big issue on that is liability coverage, for bodily injury and property damage. I've given you typical numbers here, but this is the most expensive component of your auto insurance. You'll also have coverage for medical payments. Comprehensive damage can be another fairly expensive component, and also collision damage. I've put $1,000 deductibles in here. You can get much lower than that if you want to, but what you're better off in most cases self-insuring rather than putting in really low deductibles and paying a higher premium for them. You'll also have a clause in there covering an uninsured motorist in case you get hit by somebody who does not have any insurance. For homeowners insurance, you normally got the dwelling covered, plus any extension, any other buildings or whatever, personal property within the dwelling, and you usually have coverage for loss of use. The one thing you wanted to check on here in your policy is whether you have whether the policy reimburses the cash value, in other words, the depreciated value of the loss, or the replacement cost if you have to go out and buy a new item today to cover something that was lost. There would also be a personal liability clause in your homeowner's policy, which covers damage to the property of others and also medical payments to others. This can be a major point in the cost of that could be significant because the liability issue we'll be talking about in more detail in a few minutes. Note that your typical homeowners insurance does not cover damage from flood or earthquake. Flood insurance, most people don't bother with unless they happen to live in a floodplain, in which case it will be typically mandatory. Earthquake insurance has been evolving over the last few years, that it's not all that straightforward. The big issue with the earthquake insurance, I think, is the deductible. Some policies start at a deductible as low as 5%, or some that goes up to 25%. They will typically cover the contents of the home and the living expenses as well. But the cost can be fairly high. The numbers I've seen are about 0.2% per annum with a 15% deductible. That sounds reasonable until you put the numbers in and you see that you're talking about paying, for a $1 million home, you're talking about paying $2,000 per annum with a $150,000 deductible. The problem is that in most cases, you're not going to exceed the deductible. That'll only show up in a very limited number of cases, fortunately, I guess. Typical damage might be the loss of a brick chimney or something, of that nature, but it could well, cost you a few tens of thousands of dollars to fix, and you probably only very, very rarely exceed the $150,000 deductible. So a lot of people elect to self-insure in that case, but it can be, a personal decision. Health insurance in the US is expensive. We're paying twice what anybody else is paying in most of the other developed countries. And that's something that, that we need to look at carefully in the future. But it's one area where I think we've a lot to learn from what goes on in some of the other countries. Medicare, for those folks over 65, it kicks in. But there are major gaps in Medicare, and the big gap, the first big gap is there that it doesn't cover any foreign travel. Once you leave the shores of the U.S., Medicare does not cover anything there. Also, there's no long-term care, or very little long-term care. There's short-term care built in, for a few months, but no long-term care built into Medicare, or into normal healthcare insurance policies for that matter. But we'll be looking at Medicare in more detail at our next workshop. Social Security we'll be looking at our next workshop as well, but a quick summary of it here is that the Social Security Administration calculates a primary insurance amount, the PIA, and if you are at your full retirement age, that's the benefit that you will get at that age if you retire at the full retirement age. Full retirement age for most people is going to be about 66. It ranges from 65 to 67 depending on your birth year. And you can take early retirement as early as age 62, but your PIA is going to get cut by 25%. And you can elect late retirement, in other words, delay taking your benefits until age 70, and your benefits in that case increase by 8% per annum. It's not a bad, it's actually a good deal. Up to age 70, but after age 70, that no longer applies. So you don't want to defer beyond that. But again, we're going to be looking at that in more detail at our next workshop. From here, I want to look mostly at some of what I call the potential train wrecks, and life insurance is one of those. For a young family, if you got a young wage earner with 2 or 3 kids that they want to put through college, probably that's the most suitable use of term insurance. Term insurance just gives you insurance for a limited number of years at that premium, and then at the end of that term, the premiums you can reinsure for a follow-on term, but the premium will have increased. But the main purpose of life insurance in general and term insurance specifically is to replace the future earnings of the wage earner in case he or she dies prematurely. And that as the wage earners grow and their investment portfolio grows, there's less and less necessity for life insurance, because they can, if the tragedy occurs where a wage earner dies at a later point, hopefully the investment portfolio has by then been built up to the point where they can cover at least some of the future expenses themselves. Typical costs for a 20-year term, a $1 million policy, is going to be somewhere in the region of $3,000 to $4,000 per annum for a 55-year-old non-smoker, and it goes up significantly with age. It depends on age, it depends on your health, and it also depends on your smoking habits. Smokers get dinged pretty heavily. There can be as much as a 4x bump in the premium for those folks who smoke. There are a whole bunch of variations on life insurance, but beyond the term that we've just discussed, there are actually a range of whole life policies. There's universal life and a bunch of others, but they have the common theme of building a so-called permanent investment account into the policy, so that with the term insurance, at the end of the term there is no account, no investment. It's pure insurance. But with a whole life policy, the goal of the insurance companies is to build in an investment account that you contribute to on a month-by-month or year-by-year basis, along with your life insurance premiums. One of the problems here is that the commission can be quite high for these, certainly over 50% of the first year's premium, sometimes as high as 80 or 90% of the first year's premium. For that reason, whole life policies usually have a negative return for the first 5, 10, 15 years, depending on how much you've given up on the first year to commission. And even on a long-term basis, the return on the investment account is pretty low. Even if you live 20, 30 years, the investment return can still be as low as 2 or 3, 4% per annum. One thing that some folks advise is to consider buying term insurance instead and invest the difference between the whole life premiums, which can be quite high, to invest that in your own retirement portfolio. Other combinations of life insurance that may be of interest, actually, especially lately, would be some of the hybrid life insurance policies, sometimes known as combo policies. These incorporate along with your life insurance, they can include a long-term care rider. We're going to be discussing that in a few minutes, but it can give you an access to a longer term policy through this channel than it might on an independent long-term care policy. The lump sum premium or payments can cover 15 to 20 years, and the dollar amount that you don't spend on long-term care over that time period goes to the death benefit itself. In other words, whatever you use for long-term care comes out of the death benefit. But it means if you do not need or use the long-term care, then the full death benefit will be available to your heirs. One of the advantages of this is that it removes the uncertainty of premiums rising with time, which can apply to a pure long-term care policy. So it's something that you may want to consider. Disability insurance takes care of what I consider a worst case set of conditions than the loss of life of the primary wage earner. If the primary wage earner is involved in an accident on a freeway or something like that, where the family could be in which, if he survives the accident but needs, is heavily disabled, that could be a huge burden on the family, in that they not only do they lose the wage earner's income stream going forward, but they also have the burden of heavy duty, or they may have the burden of heavy duty long-term care for decades to come. And that can be a huge financial crunch for a family, especially a young family. Very often, some level of disability insurance will be provided by many employers and be included in the benefits package, but for those folks that don't have access to that channel, it typically costs somewhere in the region of 1% to 3% of earnings, per annum. Most disability insurance policies pay out approximately 65% of the earnings, and then they stop at age 65 because they figure you'll be retiring at that point, and you need to have your retirement portfolio in place by then anyway. But they limit the payout to something like 65% of earnings because they want to give you the incentive, obviously, to get back to work if at all possible. Things to note in the policy be whether the policy covers own occupation or any work environment. With an own occupation, the insurance company will continue the benefits if you are unable to get re-employed in your own occupation. Like, for example, if you have a surgeon who has an accident to his hand and he is no longer able to perform surgery, if he only has an any work clause, the insurance company could argue that, well, okay, we realize you can't perform surgery anymore, but there's no reason why you can't do a desk job. So some of the payments could cease. You need to be careful with which clause is in your policy. Also, disability is not covered by Medicare except for on a short-term basis. Again, for folks who are doing rehab in a skilled nursing facility after hospitalization. So that's not a very good access to disability insurance. For long-term care itself, I just want to talk about for a few minutes about what's involved in that. For people age 65, approximately 70%, I've seen numbers 60, 65, 70% of people over age 65 are going to need assistance with some of the activities of daily living, the ADLs. That can include bathing, dressing, eating, transferring incontinence, and toileting. And sometimes it includes cognitive impairment, or dementia, Alzheimer's disease, something like that. Although that's not always a given. The data I've seen shows that the average duration of people with long-term needs is about 3 years, but anywhere up to 20% of people needing long-term care have it last over 5 years. That's a severe burden. Somebody with dementia, for example, could be physically fairly fit and live for 10, 15, 20 years, but still need access to some aids. And the other issue to consider here is that women have a greater need for long-term care because they live longer. That's a simple fact. So keep that in mind. Insurance for long-term care comes in a number of different forms, but again, it's fairly expensive. Long-term care itself is expensive. Typically in an assisted living facility, you're going to pay somewhere in the region of $100,000 per annum. It may be more locally here, and it may be a little less, in other parts of the country, but it's a fairly sizable cost. And as I said before, it's not covered by your health insurance policy or by Medicare. So you should consider purchasing a long-term care insurance policy. And the general thought on that is that it works best for middle-income people for one simple reason. Financially challenged folks can't afford it. It's expensive, and you're talking about a few $1,000s per annum, which may not be affordable to some people. And the other issue is that rich people can self-insure. They don't need it. So for the most part, most of the long-term care policies are sold to middle-income people. And the other thing, like I said here, is that you may want to consider a hybrid hybrid life policy with a long-term care rider, or a hybrid annuity with a long-term care policy included. An item here that may be of interest to some folks is that if you happen to have an old life insurance policy that you don't need anymore, you may want to consider doing a 1035 exchange on the old policy for a hybrid that includes long-term care. Just a thought. Long-term care insurers have drastically dropped. A couple of decades ago, there were over 100 of them, I believe. I think at this point, we're down to about 15 to 20 folks, insurance companies covering straight long-term care insurance. And the premiums have spiked upwards recently for that reason. In the earlier days, the insurance companies did not have very good data, and I think they underpriced the premiums, figuring that people would be opting out of their long-term care policies earlier, and they've gotten into a little bit of a bind for it, which is one reason why the number of them have dropped out. But the premiums have gone up to cover that. So it can typically cover anywhere up to $2,000 or $3,000 per annum for a 55-year-old, and it obviously gets more and more expensive, as you age more. The other thing you got to watch out for is that just because you can afford the initial premium, you got to be careful going forward, because the insurance companies can apply to the state for authorization to raise the premiums for any given class. They can't do it on individuals, but they can do it by class. So you need to be careful that your retirement plan has enough room in it to cover increasing or potentially possibly increasing premiums on your long-term care policy. There's a big advantage to, or a number of advantages to buying your long-term care insurance early. Some folks recommend as early as age 40 to 50, although it's typically much later. Most of the long-term care policies are actually sold to people in their 60s or even 70s. The advantage of buying it early is that, first of all, you get a lower premium, which is easier to deal with. Granted, that's for a longer time, hopefully, but it does put you into a lower premium bracket. And the other thing that really is important is that it protects against becoming uninsurable. When you apply for long-term care insurance, you're going to have to go through a medical check, and you can be rejected if you have some medical conditions that they consider make you uninsurable. So by buying your policy early, you can protect against that. The way I look at it is that what you're really buying with a long-term care insurance is protection for your retirement portfolio, because you're avoiding the risk of having your retirement portfolio heavily depleted if your long-term care costs spike upwards. And a lot of folks recommend using an independent agent representing a bunch of different insurance companies as a way of getting a better deal. And some of these policies can be quite complex, and there's a huge variation from one company to the next in the pricing and what's covered. And it's a lot of work to try and cover it all, research it and cover it yourself, but going through an agent can be helpful. The actual long-term care policy itself has a whole bunch of different parameters because it's fairly complicated. But the things you need to worry about are, first of all, the rating of the insurance company. There's no point in shopping by cost on something like this, because you may not need the policy for 10, 20, 30 years. And you want to make sure that the insurance company is still around at the time that you do need it. So right at the top of your list, you should go to AM Best or some of the other rating companies and check the ratings of any of the companies, the insurance companies that you're considering. You need to make sure that the coverage includes in-home care as well as at a qualified facility. A lot of the earlier ones only covered qualified facilities, but I think most of them today cover in-home care as well, which is obviously an advantage if you prefer to stay in your own home as long as possible. The term for most of today's policies, I think, don't go beyond 6 years. Older policies, you can buy a policy for life, which is by far, in my humble opinion, the desirable way to go, because you may be able to self-insure for 3 or 4 or 5 years, but the real risk here is that you live for 10 or 15 years or longer, perhaps with dementia requiring long-term aid, but still, with an extended duration. So it's a shame, in my opinion, that a lot of today's policies don't go beyond 6 years. Inflation is important because, again, you may not need this for 20 years, and the costs then can be very, very different to what they are today. A lot of policies offer a 3% per annum inflation rider or something like that. Obviously, the dollar amount that's paid out monthly is going to affect the policy limit. Maybe $100 a day, $200 a day. In other words, $30, $40, $50, or $60,000 a month. If you're struggling to pay for the to find the cash to pay for the policy, that's actually one thing that may be negotiable to some extent. You don't necessarily have to have the insured amount cover all of your expenses, because you'll still have Social Security coming in, and you may be willing to self-insure for some of it. So you may want to consider lower dollar amounts than you initially thought you needed. The policies usually have an elimination period built in, which is typically anywhere from 3, 6, 9 months is fairly common. And I would suggest that you consider self-insuring for the first 9 months or 12 months or whatever, because that will reduce your premium significantly. Premium cost can be anywhere from 3% to 10% per annum, at age 65. But you also want to look at whether the premium is waived once the long-term care starts. Once they start paying out care for you, some of the policies will waive future premiums, some won't. And most of them will also give you a spousal discount available for couples. If the 6-year limit here bothers you, that's a good reason to try to look at a hybrid life insurance policy or an annuity, because they generally will go beyond that 6 years. And it's a shame that you can't get a clean long-term care policy on its own, standing in its own right, I think, with longer than that. But consider the hybrid. If somebody does need long-term care, it can start off very simply where you're just looking for family and friends to help. That can graduate as you get a little bit worse, perhaps where you need home health care aides to come in on a daily basis, perhaps to cook meals or stay for an hour or two or whatever, or even all day. Adult daycare centers are an option. But if the problems, if the disability continues or persists, you may want to consider moving to an independent facility. And the ones I've looked at here are known as continuing care retirement communities, also known as, I guess, lifelong communities, where they offer a range of benefits, starting with independent living, which is kind of like renting just a simple apartment, but you do everything to take care of yourself in all regards. Assisted living will include help with some of the ADLs that we looked at earlier, and also that may progress to skilled nursing. And some of the units actually have a memory unit as well for folks who are physically fit but have memory problems. Then the final stage in the progression would be hospice care. And a few of the CCRCs do include hospice care as well, but not many. Continuing the care retirement communities, the CCRCs will usually help with meals that provide housekeeping, transportation, to shopping centers or theaters and stuff like that. They obviously provide assistance with ADLs as required, and they all have some level of programs for recreation and social activities. I've given a list here of 6 or 7 CCRCs in the Bay Area that might be of interest to folks that want to look just at those that go all the way from independent living through memory care units. But there are many others that do a less complete list, that do some of those ADS, some of those benefits. Another possible train wreck that I wanted to look at here is longevity risk. Most folks don't think of living to age 100 as being a problem, but from the financial perspective, it certainly can be a financial risk. If you think of it, of trying to put together your retirement plan, it's very difficult. In fact, any of you who sat in on my retirement workshops would have heard me say that calling it a plan is really a misnomer to begin with, because you've got so many known unknowns in there that it's really tough to put together any forecasts that are meaningful. But you should still try to do it, and it's still a worthwhile exercise to do. But you need to update it every year, and you've got all of these unknowns to worry about. You don't know how long you're going to live. You don't know what your healthcare expenses are going to be like. You don't know what the retirement portfolio the return is going to look like. Inflation is low right now, but over the next 20 or 30 years, who knows? And these are just the known unknowns. And there are also a bunch of unknown unknowns that can kick in, black swan events that we can't even foresee at this point. So in order to deal with all of these uncertainties, you may want to consider buying an annuity to transfer some of that risk to a third party. That's one of the ways of handling the risk that you're unable to take care of or unwilling to take care of yourself. But before you go looking for a separate annuity from an insurance company, first make sure that you have delayed your Social Security benefits to the maximum amount, to age 70, because that in fact is the best inflation adjusted annuity that I know of. You're getting 8% per annum for each year that you delay is hard to beat with any of the commercial options. So a basic annuity model would be that you pay a premium now, or you can, in some cases, pay it over a period of months or years, and the insurance company then contracts with you to pay you a monthly pension for life. The payout that you get each month is going to include a partial return of principal. So don't think of it as, don't go comparing it to what you might get from a bond ladder or something. It may look high compared to that, but you don't get, it includes a return of your principal, and you get nothing back, or your heirs would typically get nothing back, at the end and when you pass away. So it's unlike a bond ladder, which might have a residual principal available. For the payout for most annuities, a basic annuity is typically higher than you get from an investment like a bond ladder. And one of the reasons for this is because folks who don't live for very long subsidize the payouts for those who do live longer. Those folks who die early are not getting very much out of the annuity, and that can be used to bump up the payout for those folks who live to their 90s and beyond 100 perhaps. One thing you should note here is that it's impossible for you to calculate your own rate of return, because you're looking at a cash flow going forward that ends on the day you die, and you can't know how far forward that cash flow goes to calculate it yourself. Your heirs can calculate your actual rate of return, but you can't. There are a bunch of variations. Again, annuities can be quite complex. Yeah, they can be fairly simple, which I suggest you stick with, but there are a number of complications and decisions to be made. The decision to look at is, do you want an immediate annuity that starts paying the month that you sign up for and pay your premium, or do you want to defer the payments to age 75 or 80 or 85? In other words, pay a premium up front and agree with the insurance company not to take any benefits to a later age. Other decision you want is whether you want a fixed payment every month, or do you want it equity indexed, indexed to some equity. Typically that might be the S&P 500, but there are others, and the insurance company tries to sort of sweeten the deal by offering you a guaranteed floor, so that when the index goes negative, they will say, well, we're never going to let it go negative. We'll always guarantee you a minimum of a certain amount. And that sounds good, but the problem with that is it has to be paid for some way or other, and they pay for by putting a cap on the maximum benefit that you can get. They usually use options to track some of the indexes, but if the index goes up, in a good year, 20 or 25%, like we saw, for example, in the late 90s, the insurance company won't pass all of that on to you. They may limit what you get to 10 or 12% as a maximum coming out. But otherwise, it tracks the index within the range, and some folks prefer that. I personally prefer to go with the fixed payment and keep it as simple as possible. The other decision that you want to make is whether you want to have the annuity on a single life or joint annuity. In other words, if the person with the annuity passes away, do you want to have your spouse covered as long as he or she lives, or should the annuity stop? If you're going with a joint annuity, then some companies offer 100%, continuation of 100% of the benefits. Some do only half the benefits going forward after the first death, or there may be other ranges in between. I've seen some at 2/3, I think. One of the things that people find worrisome about annuities is the concern that if they sign up today for an insurance company, with an insurance company for an annuity, and they pay their significant premium, perhaps hundreds of thousands of dollars, and they get run over by a bus tomorrow, that whole premium is forfeited. That's one of the downsides of a simple annuity. So for that reason, some offer a period certain clause where they say that once you've paid your premium, they're going to continue the benefits for at least 5 years or 10 years or some such amount. Now, if they include a clause like this in there, it's going to reduce the monthly benefits that you get, but some folks feel more comfortable with a period certain clause. I've said there are countless complex variations. It gets the whole bunch of other ones beside these, but I've included here the main options that are available. In general, I think I would suggest you start with something simple, like an immediate annuity, and then look at how you might want to proceed from there, what's important to you. I also like the deferred annuity because I know that within reason, it's easy enough for me to plan my portfolio to age 85, but the gap between age 85 and 105, it's tough to manage a portfolio over that time. So having a deferred annuity kick in at that point is attractive to some people, not necessarily everyone. I've looked at some data from single premium immediate annuities. In other words, you pay a premium now and then you get a cash flow for the rest of your life starting immediately. Now, look at what cash flow you get per month for a $100,000 premium now. Now, this is data that I've done in the first week of March. It changes with time, not too quickly, not too drastically, but it will be different to what you would have seen a year ago or next year. But it gives you a ballpark number, which is all I wanted to do. So if at age 60 you decide to make a $100,000 premium payment, typically you will get about $421 per month, which works out at 5.1% payout. Now recognize this is not the yield. This is the payout, which includes, as I said earlier, it includes a partial refund of capital. I've made a mistake here. I can see it right off. It's $405 for a female. Now, women live longer, so they have a lower payout. And in this case, the payout for a 60-year-old woman would be at 4.9%. And if folks get a joint annuity, it drops even more to 4.3%. At age 70, the numbers go up a little bit, 6.6%. At age 80, you get the insurance company figures you don't have that much longer to live, so they can give you a 10% payout. These are just typical numbers, ballpark numbers to let you see the order of magnitude of what we're looking at. I'll correct that error there before I put the slides online, I hope. Deferred annuities, as I said, you make a premium payment now, but you contract with the insurance company not to receive any benefits until a later age. And what I've done here is somewhat arbitrarily pick age 85. And say for somebody who makes a $100,000 payment and elects to take benefits starting at age 85, for a man, if they make their premium payment at age 60, they can expect to get a 39% payout, much higher payout. For women, it's 31%, and then for a joint, it's 22%. The reason this is so much higher is that some folks at age 60 will not reach age 85. So the premiums for those folks can get bonused into the premiums, into the payouts for those folks who live beyond age 85. If you wait until age 70 to purchase the deferred annuity, then the premium or the payout could be 28%. At age 80, it drops. Going back, I didn't give the data, but going back the other way, if you bought a deferred annuity at age 50, for example, in some cases you can actually get more than 100% payout. In other words, if you paid $100,000 in your late 40s or some age like that for a premium, you can get $100,000 per annum from age 85 onwards. So it's pure insurance at its best. It's cheap insurance, but there's a long time period before you start seeing the benefits. I said that insurance really is not, you should not think of it as an investment. You should think of it as transferring risk. But I couldn't resist trying to calculate the rate of return that you would get from a single premium annuity and from a deferred annuity kicking in at age 85. And if you buy a single premium immediate annuity at age 60, you're going to have a negative return because of you've only accrued a smaller percentage of your so-called investment at age 70. And it takes 20 years before you kind of reach break even, and beyond that it goes up a little, but it never gets beyond a fairly low internal rate of return. And if you buy it at age 70, again, you've got negative for the first decade or so. And then for age 80, the same thing applies. This is why I'm saying you should not think of the annuity as an investment. You're seeing rates of return that are probably not competitive with what you might be able to do with your own separate investment portfolio. But remember that your own separate investment portfolio has risks involved with it that aren't applied here. These are guaranteed cash flows. For a deferred annuity, if you buy it at age 60 and it doesn't kick in to age 85, you've obviously got a negative return for the first 25 years because your first cash flow doesn't occur until age 85. So you've got negative return. Then at age 90, you've gotten 5 years worth of benefit out of it, so you get at least a positive return that goes up a little with time. The same thing goes for the 70 and buying at age 70 or buying at age 80. But I'm giving you this data here just as a guide as to what the investment returns might be like if you were to look at it from that perspective. But I actually don't think that it's constructive to do that. The main takeaway on the annuity, as I see it, is that you should consider covering the gap between your basic living expenses and what Social Security benefits can cover of that. Well, whatever the shortfall is, you may want to consider buying an annuity to cover that. So you know that going forward, regardless of how long you live, between Social Security and the annuity, you will always have your basic living expenses covered. That's a good way to get a good night's sleep if you know that those are covered no matter what happens to the stock market. Whatever is left, you can invest in your retirement portfolio and use for your discretionary expenses, for travel and stuff like that. What I've seen for a lot of advisors say is that for buying your annuity, you certainly don't want to put all your money into it. Some folks would argue that you shouldn't put more than 25 or 30% into an annuity, but that's probably enough to cover your basic living expenses. So with an annuity, what you're really buying is literally countless nights of good sleep without worrying about how to put a roof over your head and food on the table for your 110th birthday party. I'm being an optimist here. But regardless of how long you live, you should be able to sleep comfortably knowing that your basic expenses are covered, and anything from your investment portfolio can be freely spent on hobbies and travel and so on. I want to take a little time to cover liability litigation. I've already said that you can have some coverage in your auto policy and your homeowners policies, but that's typically a few $100,000 and may not be adequate. You can get into trouble with a tragic one-time mistake that a simple slip can get you into trouble. It doesn't have to be you yourself. It can be some of your family or whatever. The typical liability umbrella policy will cover bodily injuries to others. One possible way that might kick in would be if you have a teenage driver who T-bones a bunch of attorneys coming back from lunch. There could be some serious damages involved there. How about a guest leaving your house causing a drunk driving accident? It's unlikely you're going to get sued for these, but it is a possibility. Property damage. What happens if the beautiful oak tree that you've grown to love and have picnics under and all the rest of it, if a branch or all of it comes down and crashes through your neighbor's house, you're going to have some liability there. What happens if you insulted somebody, when slandered or libeled somebody, and they file suit? So a lot of these are unlikely to happen, but it's possible to happen, and you may want to consider buying an umbrella policy so that if the unthinkable does happen, that it's not coming out of your paycheck and your retirement portfolio. So who needs an umbrella policy? Well, you should certainly consider it, if you have assets that go beyond the coverage in your auto policy and your homeowners policy. This covers what I consider the classic scenario where the insurance model really kicks in, and we've already said earlier that where insurance comes into its own is for high risk events with low probability. That's exactly what this is designed to cover. And for that reason, it's actually not that expensive. Some assets may be protected already. I'm a little, out of my league in all of this, so you want to check this with your own attorney, but ERISA, the Retirement Act, covers a lot of employer-sponsored retirement accounts. In other words, your IRA may already be protected from civil liability, so you may not need to include that when you're figuring how much you need to have your umbrella policy cover. I think your IRA may be covered up to $1 million. The equity in your home, by some states at least, is protected. And Social Security benefits are usually protected from private debt. So these are things that may not be vulnerable, that you may not be vulnerable on, but you should really check frankly, with somebody who knows. How much coverage do you need? Well, the absolute minimum, I think, is somewhere in the region of $1 million to $2 million, because anything less than that may not get the insurance company's attention. But if you have a $2 million policy and you get sued for $5 million or something like that, the insurance company, before they make a $2 million payout, is going to make sure that they put their best attorneys on it. And what you really want with your minimum policy is at least to have it high enough to give them the incentive to defend it to the best of their ability, rather than just settle it as a nuisance suit. Most policies typically are in the region of $2 million to $5 million, but people make a mistake. A lot of folks figure that they insure for their net worth and that covers it. it may be a reasonable starting point in figuring what you need, but you have to be careful because it is an error to think that way. I mean, if you have a $2 million net worth and a $2 million umbrella policy, and you get sued for $5 million, that can wipe you out right there. Because the insurance company may kick in their $2 million, and you still owe $3 million, and you can have future earnings attached. That's certainly if you're still working, and this may be able to attach some other earnings. I'm not sure how much of this can cover, but the point I'm making, the takeaway here is that having a policy that just covers your net worth and only your net worth is not foolproof. It may go beyond that. Very few people go beyond the $5 to $10 million maximum. I mean, if you're a high net worth person, you may want to consider that because you may have additional vulnerabilities. But most policies are in this range. Cost is actually fairly cheap. It's one of the few insurance premiums that I regard as being cheap, mostly because it's a low probability. Typical policies will the premium be in the region of $150 to $300 per annum for the first $1 million, and then there's a discount. It costs less for each additional million. So it really isn't too expensive. I've given you here a list of some additional reading material that you may want to cover to dig up. It covers most of the stuff that we've discussed, from life insurance, long-term care, liability, umbrella policies, and so on. A whole ton of references here. I've also given you some useful websites if you want to get your own quotes these websites here include general information on insurance, along with free quotes on anything you might want. You can get long-term care quotes from these two websites, and annuity quotes from these. And one that I find interesting and useful is this website that lets you input your health parameters and your family history and stuff like that to come up with an estimate of how long you're going to live. And it can be, it's obviously not a foolproof thing, but it's a guide to information that may be useful in planning what you want to do elsewhere. And finally, we have our mandatory cartoon here. You've all seen the ads on TV, which says, have you been in an accident that didn't, which you weren't at fault, call this number right away, etc. And our little friend here, our four-legged friend, is saying, seriously, it was one spot on the carpet and you got most of it out. Anyway, that's it for today, and we look forward to seeing you at the next workshop, which will cover Social Security and Medicare. Thank you for joining.